Hey guys, hope you're doing well. Hope you had a great Memorial Day weekend. And I do owe you this video. I told you after our last meeting concerning life insurance, we talk about ways to utilize the policy. Two different ways. Okay, one we're going to cover today is a way to buy real estate through your policy. And then secondly, how that same policy will also create passive income in and of itself. So two streams of income from one asset type. There's two different ways to buy this property. One with cash, one with your policy. Let's say it's $100,000 to buy this property. We know from research that gurus about rentals would say if you can't get 1% in rent, it's really probably doesn't work. The numbers just can't work out. So 1% of 100,000 means we've got to be able to get $1,000 in rent, and we're going to say that's monthly, okay? In this case, we're going to compare this over a 30-year time frame. So if we had $100,000 in cash or $100,000 in our policy, we could use it either way. In this case, if we use $100,000 in cash, we would then start to gain $12,000 a year in rental income gross. That's before expenses and all that. But let's just say that you had that. So over 30 years, that's $360,000, right? Not too bad to turn $100,000 into $360,000. Now, on top of that, we're also going to get some appreciation, right? So let's just let's pull up our appreciation calculator here, and it shows us that in 30 years, $100,000 will actually grow at 3% is a rough estimate of appreciation in the Birmingham area. That's going to give us a new value of $242,000. I'm just rounding there in terms of the total value. So we've turned $100,000 into both from the rental and the increase in value up to, let's see, what's that number? $602,000. But we have to factor in the fact that it costs us $100,000 to do that. So we back out $100,000. We have $502,000 to show for it. Still, not a bad investment. You can see why people utilize real estate as a wealth building venue or a place to park money and create wealth. Now let's flip side here. Let's go to the other side. If we had $100,000 in our policy, and I'll show you an example in just a second, then what we're actually doing, if you remember, is we're not removing the $100,000. We're just borrowing against it, just like equity in your house you can borrow against with an equity line, right? So instead of removing the $100,000, we're going to borrow it. Now, when we borrow it, it's going to have a cost, right? There's actually a cost of what that payment would be, okay? So if I have $100,000 and the interest rate on these are typically 4 to 5%, I'll just go ahead and say over 30 years, monthly payment is $535, right? So out of $1,000 a month, I can then assume that I'm going to get about $465 per month instead of the $1,000, right? So if I then take 465 and I again multiply that by the same 360 months instead of the 1,000, then I have 167,000. Hopefully you can see that on your screen. 167,000 as my total amount of rents received. So I'm going to write that over here. That's my rents that I received, okay? Now, add to that the same amount that I was going to get for my appreciation, which is the $242,000. And you can see that I have $409,000. Now, just looking at the two there together, you're saying, Joey, this is a bad illustration. I'm actually getting more money by using cash than I am on my policy. But wait, remember, we never removed our $100,000 from the policy that was gaining interest. Remember, compounding interest is so incredibly powerful. Now, these things can average between 4 to 6% in terms of the way that the policies grow. But in general, I'm just going to use 5% as our number here, okay? And what that amounts to is if we take 100,000 and don't include any additional payments. This is just $100,000 one time at 5% over 30 years. That means that $100,000 grew to $432,000 more dollars. It's pretty powerful. Now, when we add that up, what does that do? That brings us to $841,000. We did the exact same function, right? We used $100,000 to buy a piece of real estate. We collected rents. We had the house appreciate over the same time frame. But as you can tell, between the two here, there's over $300,000 more in one column than there is in the other. So doesn't that by nature tell you, what if I could create 3 more houses at $100,000 a piece and create those lifetime passive income streams just by changing how I purchased the real estate? That is what we're talking about. So I told you I'd show you a way to do that. If you have questions about it, email me, text me, whatever you want to do. Guys, don't forget to sign up for this month's Lunch and Learn. It's June 15th, 11:30 to 1 here at my office. We are going to be talking about lending, peer-to-peer lending, hard money lending, bridge loans. We're going to have a special speaker you won't want to miss. This is stuff that I've personally done and can't wait to share with you. Also, some different strategies on how to get rid of loans in your life to lower those expenses. So you don't want to miss it. Sign up. Look forward to seeing you then.